Don't depend on your investing money or your trading money to live on. Don't quit the day job. Every stock I buy, I have only one objective. That's to hold it till it goes up to the profit goal. It doesn't matter if I make money or lose money. If I follow my rules, I had a good day. One of the aspects of this business that's difficult is you make a lot of mistakes. In ordinary life, we don't do that. If you're going to hold a stock that's going to go up 4 or 5, 600%, you've got to be able to hold them through a base. You just have to not let it bother you that you're having a lot of stocks that aren't working. You just keep at the job. I don't want to be buying something where I'm moving the market. In the next 20 years, there'll be 200 stocks that will go up 5 times or more. Getting just 2 or 3 could just change your whole life.
Okay, welcome back everybody to the TraderLion podcast brought to you by the Ultimate Trading Guide. You can pick up your free copy down below in the description. Joining us today is someone who I've wanted to chat to for quite some time. Many of you guys have recommended me reach out to him. We have Lee Tanner, a longtime CANSLIM trader and the IBD Meetup leader over at Petaluma. So Lee, great to have you. Really looking forward to diving deep into your process and seeing how a CANSLIM aficionado really gets things done.
Thank you. It's a pleasure to be here.
Great. And to start with, I always like to dive into people's background. So I'd love to kind of hear about how you first got interested in the markets and also how you discovered and got going with the CANSLIM investing strategy.
Yes, well, in the mid 80s, I had saved enough money from my regular work that I was interested in starting to invest some. And so my father and his sister and brother-in-law had long time been stock investors. When I was a youngster, they were stock investors, and I heard them talk about stocks from time to time. And I even remember some names that they mentioned, Lorillard and Brunswick and others that they were talking about at the time. And so when I had some money saved up, I started casting about. And the first thing I did was I got a full service broker, full service brokerage account, and started buying some stocks and other stuff through that, and started reading the basics and the material that the broker handed me and things like that, just learning the terminology. I was home visiting in early 1985, and I asked my father, I said, well, I'm starting to get interested in investing in stocks and bonds and other things, what suggestions do you have? Now, my father always, when I was growing up, his hobby really was the stock market. He always had stock market books. He never read much of anything else except stock market books. And he also was a chart reader, and he subscribed to a chart service from that had some weekly charts and some daily charts. And it was an outfit in Boston, Securities Research Company. I can remember the names, and they were blue and red. So he was, I knew he really knew about stocks. So he said, well, okay, and he introduced me to some of the classic reads, Bernard Baruch, Jesse Livermore, I think Humphrey Neal, and he had the books, and he said, here, you can borrow these books. And so I went home and I started to read some of that stuff, and I came back to visit it again a few months later, and he said, I said, well, I'm reading these books and stuff, and I have a brokerage account. And he said, well, if you're really serious about this, you ought to look at this paper. And he always read Barron's and the various magazines, Forbes and Fortune and Business Week, but he had this newspaper, Investors Daily. He said, you ought to read this paper. He said, the job I had, I was on the road a lot. So he said, you can buy it in the newsstand, you can get it at the hotel. And so he said, this is a really good paper. It's very focused on stock investing, more so than anything else. And he said, and this guy that has this paper really knows what he's doing, And so I said, okay, great. So my father then introduced me to the chart books, Daily Graphs. He subscribed to Daily Graphs. And he said, if you're really serious about learning this, you ought to get some of these chart books. And so that's how I really was introduced to Investors Business Daily and Bill O'Neill. Now, at the same time, I was busy with real work, and I had this broker, and I was not investing just in stocks. I was buying quite a few things. I bought some stocks, I bought some bonds, I bought some junk bonds. In fact, I had quite a portfolio of junk bonds at that time. And I got an account at Drexel Burnham Lambert in addition to the other brokerage account I had. And I really liked junk bonds because it was easy for me to do that while I was working. The job I had kept me pretty busy. But I was reading about the O'Neill, I was reading the IBD, I was reading other books and stuff, and sort of getting there. Now, a little bit, a year or two later, I read about this way you could get real-time quotes at home. And my father actually had one of these ProTrek things.
Mm-hmm.
And that company came out with a thing you could hook up to your computer to get real-time quotes. And so I thought, that'd be kind of interesting. And so I got that, and I hooked it up to my PC. And so when I was home, not working I was a business consultant at the time. So when I was between jobs, I really sort of dove into it and started reading a lot more about it. And the interesting thing is there wasn't a lot to read on CANSLIM.
Mm-hmm.
I did subscribe to the chart book, the daily graphs, on a monthly basis, not a weekly basis, because I wasn't home that much. But each chart book had an example in the front. It said, this is a winner, and this is what it looked like before it went up 250%, and these are the things you should look for. And so I started learning it that way, and it was a slow process, I would say. In 1987, I had put together a portfolio that I thought was along the lines that IBD was describing, and I was still working full time, more than full time. The job I had was very long hours when I was on the job, and I was at this company, and I didn't go to lunch that day, and the engineers come back from their lunch, and we talked about stocks and everything. The guy said, "Geez, did you hear what happened to the stock market? It was the '87 crash."
Yep.
And so I went back to the hotel, and there's Dan Rather saying the next Great Depression is starting. Well, I had a full portfolio, and there's nothing I could do about it by then. It had crashed. Well, a year later, everything was okay. So that was my first bad lesson in sell rules. And so at any rate, about a year after that, I was really digging into the O'Neill method a lot more. And his first book came out around that time. And boy, that was manna from heaven as far as I was concerned. Because here is a book that describes, what the daily graphs are saying and what the newspaper is saying. And I wasn't really quite getting it. So that was a big step forward in the CANSLIM pursuit. Now, I still had a whole bunch of junk bonds, and they were fine. The junk bond crisis occurred around that time, and I didn't get hurt because I was earning good money, and I just didn't have to sell anything. I just kept them all to maturity, and they were fine. But and as that money freed up, I started putting it more in stocks, and my timing was lucky because this was sort of the beginning of the great .com bull market.
Mm-hmm.
And now there were some bumpy patches in there. There was a pretty sharp downturn, I think, in 1990 when the first Gulf War, the Saddam Hussein invaded Kuwait and the first Gulf War setup came. There was a pretty significant bear market in there, and I wasn't good at sell rules.
Mm-hmm.
So my portfolio tanked, and I sat there and waited. But 6 months later, it was fine. So that's sort of my journey. Now, I have studied CANSLIM and the newspaper and Bill O'Neill's books and stuff over the years, and I've evolved and refined my methods a lot. So, in the 1990s, I made good money doing this, and I thought I was a rocket scientist. I mean, geez, this is easy. Well, I didn't have any sell rules, and so it was easy. If you don't ever have to, if you can buy good stocks and you don't have to sell them, and they just keep going up, well, yeah, you look like you really know what you're doing. That came to an end, of course. For me, it didn't come to an end until 2002, really.
Mm-hmm.
I mean, I got through 2001 pretty much okay, and then 2002, it really, the wheels came off the wagon. And at that time, I really decided I needed to learn a lot more. And so I embarked on a very serious educational, self-study program in 2002. And I reread his books, and I studied them more, and I paid a lot more attention to the Investor Corner articles and the paper and the things that were online. They had a lot of educational material on investors.com, ask IBD questions, they had that kind of thing. And I took in the next, I think, 4 or 5 years, or fewer than that. Starting in 2002, I started taking the webinar, the workshops,
Mm-hmm.
and they were great. I love those. I go down and get taught how to do this by Bill O'Neill and the people that worked for him. So I took all those, including the master's class, and I really ramped up my knowledge level, and up till about 2000, between 2002 and 2005, I think I took all those courses, some of them more than once. So and then from 2005 or 6 on, I've just sort of been refining and becoming more comfortable with what I do. For example, since then, I've learned not to bother shorting.
Mm-hmm.
It doesn't work for me, and so I just don't try to do it. It was useful to learn how to do it, because I think it taught me to read charts better. Shorting is a much more of a chart reading thing. Just, you're not going to decide when to buy a stock based on the fundamentals. The fundamentals have been really good on the stocks that are good shorts. You really, it's a refinement of reading charts, and it's kind of the inverse of going long. So, but I'm just not good at shorting, because if I short, I get my head on backward.
Right.
And so I've learned from post analysis that it doesn't suit me very well, so I just don't do it. Sometimes I'm still tempted. A friend of mine was short SMCI on Friday, and I said, and of course my portfolio went in the toilet on Friday. I'm thinking, gee, it's too bad I wasn't short SMCI. But anyway.
And I'm curious, when you're first starting out, and maybe up until through the 90s, were there some mistakes that you realize now looking back you were making over and over again when you were first getting started? Of course, you mentioned the sell rules component to it, which I want to touch on for sure. But were there any other common mistakes that you found yourself kind of repeating over and over that were leading to your bigger drawdowns?
Well, I did. That was the mistake, and in hindsight, I mean, it wasn't a mistake, because I didn't sell at the low.
Yep.
So I got away with it. The market was so good, and I was so stupid or ignorant that I just didn't realize it could keep going lower. I didn't have a financial pressure on me at that time at all. I mean, none. So it just didn't I looked at my portfolio like in the first time that happened was in October 1987. Well, I was still working and making really good money, and I didn't have all my money in stocks, and so Jesus said, "Oh, this is a bummer," and but there was nothing for me to do about it. I didn't want to sell down there. I just waited, and everything came back. Everything I owned came back. In fact, one of the companies I owned was bought out shortly into that, and that helped a lot. It was bought out for a price higher than I'd paid for it. So I just got away with it. And now later on, I realized that it was a big mistake not to have sell rules, and that I needed to be able to manage these things a lot better. And I've evolved 1,000,000% since then.
Yep.
And so I think the biggest mistake I made in my early investing was underestimating how much I needed to know to be any good at this. The market was so forgiving that I could, with a little bit of effort, I could pick stocks that were going to go up. I also subscribed to 3 newsletters that helped.
Mm-hmm.
I subscribed to Marty's Wag, another guy whose name was Louis Navalier, and Louis Navalier picked growth stocks, the kind of growth stocks that O'Neill would pick. And he suggested times to buy them, and he used charting techniques to do that. And I subscribed to the Huber Financial Digest, which led me to Navalier and Marty's Wag. So I used those tools to help me pick stocks. And so since the market was so good, I was just lucky.
Mm-hmm.
I was kind of like the pilot who flew back and forth, his 747, and nothing ever went wrong, and it was a piece of cake. Well, then all of a sudden, a couple of engines flamed out, but I got away with it for many years. And some of my biggest stock winners, were in that era. Probably one of the biggest winners I've ever had was Amgen.
Mm-hmm.
And so I bought it early, and I sold it late, but it didn't seem to matter that much, and it was a piece of cake. So the mistake then was underestimating what I needed to know to be good at this. And I corrected that. I realized in 2002, I'd better learn a lot more.
Yeah.
And then another big mistake that I've made since then, and I've corrected it, was being underinvested.
Mm.
When I got through with the .com bubble burst, and 2+ 3 year almost bear market, I was reading about the follow through days and studying the market and blah 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 and all that stuff. When I started reinvesting and building a portfolio, I found that I was reading the paper too much, and it took me quite a few years, probably about 8 years, to figure out I was underinvested. I was too cautious, and
Mm-hmm.
I lost in the overarching experience in all my investing. I've lost way, way more money by being underinvested than anything else. If I had to say, the biggest mistake was being underinvested. Even in the 1990s, I was very rarely on margin then. I just, I didn't need to use it. You could make enough money without margin. And then I got into the 2000s, and I was learning and building a portfolio, more like actually portfolio management, which I was learning in the workshops and by reading Bill's books and also the workshops were good because I'd meet people.
Yep.
And so, but I was cautious. I was overly cautious. There's a follow today. Okay, well, I'll buy a half a position, and then, well, by the time I get a full position, the rally's over. And so I went back and did post analysis in around. I did a really extensive post analysis in 2008 and early 2009 when there was the real estate bear market.
Mm-hmm.
And one of the techniques I used was I went back and I looked at all the portfolios I had for quite a few years back, and I save a lot of stuff. So I looked at watch lists and of course I had all the EIBDs going back to 2003. So I could look at their lists like the 100 and the weekly review, and I went back and I looked if I managed my portfolio better, how would I have done? If I followed my sell rules carefully, how would I have done? And I found out that all that time I should have been much more invested.
Mm-hmm.
And I did the math, and it was an eye opener. And I equated it to a story that I think is in one of Bill O'Neill's books, where he talks about the store that doesn't have the dress that's in demand. You know, when you're underinvested, you don't suffer a loss. It doesn't show up in your, on your tax return. You don't know you're suffering a loss unless you go back and do the kind of post analysis that I finally did. And it was a real eye opener. And it was such a shock. I thought I must have made a mistake. And so I did it a couple of times for a couple of different periods. And then I poured over the material to make sure I wasn't, making some kind of huge error. And after that, I started ramping up how much invested I was. Also in that time frame, I pay a lot of attention to the market factor.
Yeah.
Every day, I have all sorts of tools that help me with that,
Mm-hmm.
including Market School and all of it. I kibitz with several other people on the market, but I don't use that knowledge to tell me not to invest.
Mm-hmm.
I mostly invest balls to the wall all the time. and so yesterday and today I bought 2 stocks.
Mm-hmm.
I had to sell stuff on Friday. And, technically the market's in a correction, but now when the market goes into a big correction, like it did a couple of years ago, I'm going to be buying stuff and it ain't going to be working.
Right.
But I found out for me, at the end of that, if I do that and I have the confidence of being optimistic, and anytime there's a rally, I look for a rally day, not even a follow through day. And I look for a setup. I'm not buying stuff that isn't set up. And I go for it. If I'm careful about how I do it, I don't get much losses.
Mm-hmm.
I don't need to let anything get away from me. But when the rally finally happens, I'm 200% invested a few days into the new rally. And boy, that makes up for all the losses that I had going down. And one of the reasons I don't short is if I start shorting during the time the market's going down like that, then I'm not ready for the rally. I've got my shorting hat on,
right,
and I'm not looking for the long setups. So that was a very long-winded answer to a concise question. My biggest mistake is being underinvested. And, if you're new, you can't just do that. You have to grow into it. But keep that in mind and study what you've done in the past and see if that's not maybe a mistake. And I've worked with people in my meetup group that they found out that by going back and studying that, yeah, they're underinvested and they need to work on that.
It may have been a long-winded answer, but it was a really good answer and answered questions I hadn't even asked yet. So no, that's excellent. And one thing I wanted to ask you was thinking back on the workshops and the times that you attended seminars with O'Neill. Were there any stories that come to mind about those experiences, and any kind of key takeaways that you had learning from Bill?
Well, Bill and the people around him. I mean, he always had people there besides himself who were, most of them, as I recall, were portfolio managers that worked in his company,
Yep.
William O'Neill and Company. And the ones that I got to know pretty well were Mike Webster and Charles Harris. They did a lot of teaching there, but there were others that whose names don't come to me right now. And Chris Gessel was around and there, and Justin Nielsen, and there were others. They had a good crew, and one of the most valuable parts of going to one of those things is I always went up to the front of the room, and whoever was teaching, it could be Bill O'Neill or one of the others, they would stay up in the front of the room and answer questions during the breaks. And so I didn't necessarily have questions, but I'd go up there and listen to them answering the questions. And, you'd pick up some really nice pieces of information. Then I'd run back to my table and make notes. And I took a recorder with me every time I went, and an audio recorder, and tried to catch as much as I could. And then the other thing about them that was really good is you'd meet other people who are like-minded, and you make some relationships. And I know people that I met at those things now that I've stayed in touch with over the years. And, I have in the 1990s, I worked alone, and it was isolating, but I didn't work that hard, so it wasn't too bad. And I had other things going on in my life. There were that took a lot of attention, but, my father was an investor then, but his style and my style were quite different. And so we would kibitz and talk, but I couldn't talk to him about the kind of stocks I was picking in the charts and stuff. He was a chartist, but not the way I was. But and so it was a little bit isolating. And then, but in 2001, I set up knew a guy for many years from going back from my Navy days, and in 2001 he's decided to get interested in doing this type of thing. Mike Scott is his name, and we'd known each other for a couple of decades or more, actually. And he said, "Well, show me what you do," So I did. 2001, right before there was a big correction there. I guess it was 9/11. And I said, "Mike, don't buy anything." I said, "Just read and leave your money, dry, leave your powder dry." Fortunately, he followed that advice. So when 9/11 occurred, he wasn't hurting. But anyway, so I don't remember where I was going with all this.
My original question was, were there any kind of key moments or key lessons from Bill or the people who worked with him that really stand out and helped you out?
Yeah, there were. Bill O'Neill's book, he has only one condition where he keeps a stock longer than the standard profit goal. So his basic profit and loss plan, he says, buy them here at the CANSLIM breakout, with the CANSLIM properties at the pivot point, and sell them when they're up 20 or 25%. Period. That's it. And he has only one exception to that, and that's a certainteed exception. And so if you don't have a certainteed exception, you shouldn't hold the stock longer than the standard profit goal. Now, in one other place in his book, he talks about don't sell it for profits before 8 weeks. So you might hold it for 8 weeks and then the standard profit goal. But unless the stock is up 20% in 3 weeks or less, you're not going to keep it long term. In one of the workshops, he spent a lot of time talking about, you really need to have some other ways to decide to hold these stocks long term. And he talked about things you should look at. And it was the school, the chart, the class was the model stock summit. And he spent a lot of time. I think he spent an hour on that topic. And that was good. That was good. And so, and he said, if you have 10 stocks, you ought to figure out a way to hold maybe 2 or 3 at least of those long term past the standard profit goal. Because you said that's the way you really make big money in this business, is holding something for a few years, and it goes up 400 or 500%, and you add on as it goes along, and it really becomes a big position. And of course, he was talking about stocks he held for years, like Price Club and the other one, I forget, the shopping company he had. But so that was an important one.
Yeah.
One of the other key lessons I got in one of these workshops, and it was an eye opener. It was an aha moment. Chart school, the first time I went to chart school, Charles Harris and Mike Webster teaching chart school. And they're up in the front of the room, and they're reviewing these charts, and they're talking about, well, I bought it here, and Mike Webster would say, well, I bought it there. And it didn't take the class very long to everybody in the class figuring out, these guys are doing it differently.
Right.
And in the introduction, they had described how they were both, personally trained by Bill O'Neill at the same time. I think one of them shared an office with O'Neill, and they're trained in CANSLIM investing by the master. And now here they are, a number of years later, and both of them are portfolio managers for his company, and they're doing it different. Charlie Harris liked to buy stuff on pullbacks. Mike Webster liked to buy stuff breaking out and going up. And so the hands went up in the room, and somebody asked about this, and he said, well, now, this is an advanced workshop. You guys have to figure out each for yourselves by post analysis, what works for you. And then you tailor your rules to make it happen for you. That was an aha moment. Okay, so I start out with the basic set of rules that Bill O'Neill gives us. And then through post analysis, I figure out what works for me. And that's quite okay. And that's when it gets better for you.
And do you personally lean more towards the buying on strength or buying on weakness?
Strength.
Strength, yeah.
Most of the time I buy a stock, I'm looking for the price to go up to my intended buy point.
Right.
Every once in a while, I'll buy something that's pulling back. Recently, I did. In fact, yesterday, I bought CRS, which I missed it when it went out. I didn't have much buying power, and it went out, and then my portfolio was, yeah, that's right. I tend to buy when they're coming up to a buy point that I've picked out from the chart. But once in a while, I'll buy something that's pulling back.
And I want to come back to that Amgen trade that you mentioned was one of your greatest. Would you mind kind of talking us through, how you found that stock, how you, managed that?
In fact, I'll show you the chart.
Yeah, let's do it.
I owned Amgen for 13 and a half years.
Wow.
And it was an easy own for me. I bought 100 shares. I never added anything on. And so, and 100 shares, I mean, that was, by today's standards, that's peanuts. But that was the way I did it in those days. 100 shares of this, 100 shares of that, even lot. It was a full service broker too. I hadn't, that one was. Anyway, it was purely a CANSLIM pick. Daily graphs and Investors Business Daily, reading Investors Business Daily. And of course, it was in the news a lot. It had high earnings, and then it was a newsworthy stock. And so on the daily graph charts, I picked this double bottom base. Now, this formation was in Bill O'Neill's book, which came out in '87, I think. And I sort of liked it. Double bottom, shakeout plus 3. And this is my favorite chart pattern. And so I saw this in the daily graphs charts, and I bought 100 shares right about here. And now I didn't do anything with it for 13 years. And, I mean, it had good CANSLIM properties in the newspaper. And this is what the weekly chart looks like. I didn't have weekly charts at that time. I did actually. I had a thing called long-term values, but I didn't pick this off the weekly chart. But in hindsight, you can see this week right here.
Yep.
That's really strong. And this week too, and that's when the week I bought it.
Mm-hmm.
So now I bought it way over here in late 1989. I would say it's probably one of my first like pure CANSLIM buys of something that I didn't know anything about, that other than what I could read in the paper and the magazines. I at the time I read Barron's, I read Forbes and Fortune and Business Week and stuff too, and I'd read about Amgen, and I also watched this TV show called FNN, Financial News Network, and I watched Louis Rukeyser's Wall Street Week, and there was a daily business show on PBS as well. I forget what it was called. So I heard about Amgen. I bought it here. I never added a share, and I held it through the 60% correction here. This is the monthly chart.
Yep.
And a 62% correction here here's 2000. Here's the end of the bull market.
Mm-hmm.
But Amgen just hangs in there, and then it has this correction here. I'm still holding on to it. In the summer, in like August 2002, is when I went to my first workshop with Bill O'Neill, and I learned there, God, you really need to get sell rules, and so I still didn't sell it until I got to here. And by this time, I was ready to use the money that was in here for other stocks.
Right.
And so, this with 100 share purchase, I earned $300,000 on this thing over all this time frame, and it went up by some huge percentage. So, and it's split so many times that I had 4,800 shares by the time it got over here. So that was, that owning that kind of stock was a lesson in how not to do it, actually.
The sell rules part. Yeah.
Yeah. The sell rule thing. Now, the way I would work now is I would try to buy it sooner down in here. If it had the fundamental properties, the chart looks good down in here. And then I'd probably sell it in here somewhere, and I might come back at it over here, and here. I mean, it still had great fundamental properties, but it just had this correction. Now, and so that was Amgen. And it was a great and it was nice to have all that earnings and everything. And in my situation, that was all extra stuff. I didn't need it to live on. So I put the math here. It gained 6,200%, and even on an annualized basis, it was 36% a year. I mean, you just can't do that very often.
Yeah, what a monster! Could you go back to the daily chart for just a second here? And this is more maybe a question for how you view things now. You mentioned that the double bottom is kind of your preferred setup.
It's my go-to
Yeah.
pattern. I love it. Now, it's not common. It's not a common setup if the market's rallying like it has been for the last 5 months.
Yeah.
But it's a common setup if there's a correction. If we look here, this is the, I had the NASDAQ on here when I flashed this chart, but the S&P would have been similar. See, the market was correcting.
Yep.
And this was probably about a 3-leg down correction. 1, 2, 3. And this kind of pattern sets up more so when there's a market correction, and it's basically it's not in the 3rd and 4th edition of Bill's book, but it's in the 1st and 2nd. And basically, it's a Jesse Livermore setup, and so if I see this, and if it's a stock that's priced between $30 and $60. Bill says just add $3 to the first low here. And so I tend to do that.
Mm-hmm.
If it's priced above $60, I add 5% because $3 at 60 is 5%. If it's priced below $30 a share, I add 10% to get my entry price. And so, on a stock like this, in today's world, I probably would have bought it on this day right here.
Mm-hmm.
And a lot of times I'll put a broker buy stop in with a limit. So it would have filled. And I would have held it because I have experience and I know sometimes they fill and they, I'd give it 7%. And my capital protection sell rule is 7% on the end of day pricing and 9% intraday.
Mm-hmm.
And so that's the buy setup. And I have a lot of them like that, that I use. That's very common for me. That's my preferred setup. And then I like a cup with a decent handle.
Mm-hmm. Yep.
And this was just luck that I found this in the charts. You probably never used chart books. They were, boy, it was clunky. I loved them, they were great. I'd wait for them to arrive, rip open the package, smell the fresh ink, and then start flipping through the charts.
Mm-hmm.
That's how you found things in those days. Now we use screens that tell us to look for stocks that have good earnings and whatnot and everything else, and then look at the chart. In those days, it was flip through the charts. And then if you find a stock that has a good chart, well, now look to see if the fundamentals are okay. And for the most part, I wasn't as fussy about fundamentals in those days. It was, if the chart was good, I'd be inclined to be more forgiving on the fundamentals. Of course, this company had great fundamentals.
Yeah.
And there's something new, which I didn't totally understand, but I knew it was hot.
And looking back on your trading career, were there any other trades that really, not necessarily were the huge winners that this one was, but, taught you a really important lesson or, made you change a rule that really changed how you did things, going forward?
Yeah, at this time frame, actually, one of the first real CANSLIM stock I had, it taught me I needed sell rules because I also held it like this one for a long, long time.
Yeah. Was
Home Depot.
Yeah.
And, I've got that chart here someplace. We can look at that too, briefly.
Yeah.
It's not as instructive as, it didn't make as much money as Amgen, but I held it longer actually. And I held it almost 14 years. And this was a CANSLIM pick because it was mentioned in the newspaper and there were charts. It was in the chart books, but it was also a personal use observation thing. And it was before Peter Lynch, but it was a Peter Lynch theory.
Right.
I hadn't read Peter Lynch's book by then. But, Home Depot, I mean, I'm kind of a putter around the home and Home Depot. We didn't have one in my area, but I went to a place where they had one. And wow, I was really wowed by that. And I went back to it a few times. So it was that. And so I bought that. It was, I didn't get the double bottom. I bought it here. It came out, it was a base over base pattern. I didn't see the double bottom set up here.
Mm-hmm.
So I bought it here. And, this is in 88. I held it until 2002. And again, I bought 100 shares. That was it. I think it was 100 shares. It wasn't, maybe it was 200. Might have been 200 because it was a low price stock. But not much, I didn't buy very much of a position. And I just held it forever.
Mm-hmm.
From here, now I let a lot of it get away from me. And then I sold this after I went to Bill O'Neill's workshop in August. I said, I better get out of this. And so I sold it here. Still made a lot of money on it, but I let a lot of it get away from me. If you do the drawdown math here, it's kind of scary.
Yeah.
It's 60 to, 25 or something. That's a whale of a give back. But on this chart, it doesn't look so bad. But you see, I held it through a 32% long correction. here's a correction. It's like 3 years. Didn't worry about it. And even long in here, I thought, well, it's okay. It didn't correct much more than here. But then, in 2002, it really started to tumble.
Yeah.
So again, the big lesson on that one was, pick good stocks like this, try to hold on to them for a long time. I don't think this triggered the certainty exception, but I wasn't using that at that time.
Mm-hmm.
But don't let them get away from you. I needed sell rules. I think my drawdown here was 55%. I did do the math. Then I owned another stock in this time frame that was a good lesson for me in CANSLIM work, JDS Uniphase.
Mm-hmm.
And it was a company that made fiber optic stuff for the internet. And the internet was something new at that time. And I picked this stock because Louis Navalier had it in his newsletter. And it also was in the chart books and had CANSLIM property. And this one was a cup with a handle. So that's set up. And on the weekly chart, which I didn't have at the time, but that's what it looks like now. And it had a good handle, 3 weeks tight, which I wasn't aware of at the time I bought this stock. And then from here, I hit, this is my first climax run. Now, there were a lot of climax runs that happened in this time frame, but this is the first one where I managed it as a climax run. And this is the monthly chart. And even I could figure out that this was too much, too fast. And, this is the weekly chart, and this was exciting. Oh, God. Even though I wasn't paying much attention to Amgen and Home Depot and some of the others I owned, this was exciting. And, look at this. And so Bill O'Neill had published his second edition of the How to Make Money in Stocks. And in the back of it, he had a long list of sell rules, and many of them were the climax top type of sell rule. And I studied those carefully and sold this stock very near the top up here. So that was a good lesson in that way. Years later, I had a really great time with a stock called Weibo. And it's a Chinese company, and it was really hot, and it was a climax top, and I really had a huge earnings with Weibo, both percent gain and dollars. And so, and then, and in the Weibo case, I had owned a stock before Weibo, where I'd studied the sell rules a lot more carefully and refined my sell rules, and enabled me to keep Weibo longer and to make, if I can hold on to a stock that's making a climax run and sell it near the top, there's a big delta in percentage in sometimes in just a few week period of time there. And I managed to do that with Weibo. It was a big lesson in being able to stay with the climax top. I might have that chart here if you want me to show it.
Yeah, please.
All right, Weibo.
There we go.
I bought this in 2016. It's a Chinese Twitter, which huge market. It had a 2-year base. It was the end of a market correction. And I bought it in April 2016, and I kept it for I kept it for a better part of year and a half or more. I made 12 add-ons. I really used add-ons a lot. It was up 632% from the first 5. My overall gain with all the money invested was 188%. The initial position and the first 7 buys, I all held longer than 12 weeks, so I got long-term capital gains. So, this was a really good CANSLIM. This is, boy, the power of CANSLIM and getting a good growth stock. And So this is the overall monthly chart of this thing. I think it's monthly, maybe it's weekly. And I bought it here. And at the time, the way I bought these is I scaled in.
Mm-hmm.
You know, I made 3 buys. And each of these little blue ticks is an add-on. With Weibo, I did a lot of follow-on buys.
Mm-hmm.
And I do a lot more follow-on buys than O'Neill. And I've figured these out over the years from the newspaper,
Mm-hmm.
workshops, investor corner articles, and just what works for me. And, you know, I use the ones I use are the standard ones, the 10-week bounce or pulling back easy to the 10-week line, and 3 or 4 week tight. And the most common one I use is the new high after a gentle pullback. And it's kind of like a handle. And I use that a lot. A short stroke, continuation gap up, 12 of 15 days up, or 11 of 13, or 10 of 11. And most of these I got right from O'Neill and, you know, IBD. When the certainty exception rule is triggered, I like this one the least, but I use it sometimes. At the end of 5 consecutive weeks up on quiet volume, I hardly ever use that one. That one I got directly from Bill O'Neill at the Advanced Chart Summit. And 4-week flat or square box base. So on Weibo, I used a lot of add-ons,
Mm-hmm.
and this works for me when I get a strong stock like this, I get a lot more money in the stock. Now the big gains come from here, but the gains from here are quick, you know. So if I need to, I'm selling stocks that aren't doing as well, and I'm putting money into the ones that are doing better.
Right.
So this stock from here to there, it was a huge gain. And so this was in the mid, well, it was like 2016 to 2018.
Mm-hmm.
And that was a good, strong rally in the market rally in that time frame. You know, good, steady, you know, not too difficult to manage rally. So now, you know, I've had others that were good. You know, this is a particularly good one. I made much more money on this in dollars than I did on nearly anything else at that time. In that time frame, I also had a position in NVIDIA.
Mm-hmm.
You know, I think maybe not exactly at that time frame, but it was one of the first times I got in NVIDIA, and it was very good. I sold it you know, I mean, I wish I kept it all these years, but you know, I didn't. So I had a position. I did Netflix.
Mm-hmm.
In there, and I owned Netflix over probably about 4-year period, but not steady. Yeah, this started out in like 2007, and this was a double bottom pattern here.
Mm-hmm.
And then I owned it for a certain period of time. I have the times. You know, I owned it the first time here. I owned it about 30 weeks, and I stole it at the profit goal. I made one add-on here, and I didn't sell this at the profit goal. It was above the profit goal. It tanked. It gapped down here, and I sold it. And then I waited, and it set up again. And this was another double bottom. And see, the market's correcting.
Mm-hmm.
And I bought it here as shakeout +3. And I made one add-on, and I sold it when it got to the profit goal. And the way I do this is I use the profit goal not from where I bought the stock, but from the standard pivot point, because that's what the market knows. The market doesn't know where I bought it. And so I sold it there. And this is more the style I use now. I'm not much for holding them through a base.
Mm-hmm.
And so I kept watching it. You know, this was a CANSLIM pick, but also a Peter Lynch, because I used this service. I loved it. We in our household, we were big DVD and VHS watchers, and for a long time we used to go down to Blockbuster and all that. And then this came along. This was like manna from heaven, and it was in the mail at that time. It was before the streaming, and so we loved this. And so I was watching this and bought it the third time out of this cup with handle base here, and made one add-on. And it got to the profit goal very quick, and I sold it for the profit. And then it formed this other base here pretty quickly, and it broke out over here. I didn't buy it at first because it was straight up from the bottom here. I waited, and then I bought it here. And this was the best time to own it right here. And once it rallied really quick, see all these straight up weeks?
Yep.
And then got to a point where is up 50%, and I put it on what I call my big cushion rules, and I hold it, and that's where I sold it over here. A lesson I learned on this guy was I sold it too soon. I wasn't following my rules as carefully. And so when I owned a stock after this, I was able to follow my climax top rules better and get more gain out of it.
And that's another one with a double bottom in the correction there on for your last add-on buy there.
Right here.
No, I meant further on.
Oh, right here, yeah.
Yep.
That was an add-on buy with a double. That's exactly right. And if I didn't already own the stock,
yep,
there, I would have bought it here, because it was very noticeable going up here. I'm sure it was on the IBD 50 list and all that, or 100 list at that time.
Yeah, I'm sure, bringing it to the current times, if we do get, one more leg down in the market, you'll probably be looking for a lot of these double bottom bases. Is that right?
Yes, absolutely. You're totally correct. That's my favorite thing. And, one of the questions you have is, how do I pick stocks? Well, I look for the stocks that have good CANSLIM properties, and then I watch their charts. And, if there's much of a correction like there was last fall,
yep,
quite a number of the stocks I bought last fall had double bottom formations and shakeout +3. Not all. Actually, one of the best stocks I had last fall was NVIDIA again.
Mm-hmm.
And, we can look at it quickly here since it was recent.
Yeah, let's do it.
And this was a double bottom here in this correction.
Mm-hmm.
I didn't get it here. My portfolio was full. I didn't have buying power, and I didn't sell anything to buy it. And the fundamentals weren't all that red hot right in this time frame either. The earnings had come off during the COVID.
Mm-hmm.
And so it wasn't really high on my list. But I'll tell you what I noticed over here was this relative strength. This is a very noticeable relative strength action right here. And, most of the time when there's a double bottom formation, the relative strength is way down.
Mm-hmm.
If I see a double bottom formation with the relative strength that's strong like this, that really is attention getting for me. Well, then it formed this nice little tight base on base, so I bought it right here.
Mm-hmm.
And I made quite a few add-ons to this, and I sold it recently. I just didn't want to hold it through a base. It's probably going to be good again. I just didn't want to hold it through a base. So I sold it recently. I used a sell rule that it's Bill O'Neill said, you got to figure out a way to hold some of these stocks. And so I came up with a sell rule that if it's strong when it gets to the profit goal, 25% is what I always use. I'll keep it on a short leash. And my short leash is the 10-day line, and a lot of them get triggered out, but it's a 10-day line. And I use a trigger on the 10-day line is that I got from Dr. Chris Ketcher
Mm-hmm.
of the Virtue of Selfish Investing website. It goes below the line, closes below the line. You don't sell it then. You don't sell it if it just goes below the line, but if it closes below the sell line, below the 10-day line in this case, now the low of that day becomes the sell trigger.
Mm-hmm.
And so I'll start out when this stock gets up, see, this triggered the certainty exception here, so I'd be holding it for 8 weeks, and then it gets up a certain amount. I'll use that 10-day line rule, and then when it gets up farther, I'll use a 21-day exponential line, and that's what triggered me out over here. And if I really wanted to keep a stock like this, I would transition it to my big cushion sell rules, and this wouldn't have triggered that yet. If I had bought this stock here, I would still own it. But I didn't buy it here, and the market's got a lot more altitude now than it did here. I mean, here it was coming out of a correction. Here it's extended. Because my big cushion rules come from one of Bill O'Neill's models, the Simpson precision model, and he basically says you watch for it to close the first week below the 10-week line on big volume, and that's my main rule if I get a stock I'm trying to hold for the long run.
And it seems like not just looking at this one, which obviously has a semiconductors theme and the end factor related to that with AI, but even the big winners that you had in the past, Amgen, Uniphase, JDSU, Uniphase as well with the fiber optics, they all had that kind of end factor, that kind of new element to it. Is that something that you're really focused on when, picking stocks that you want to then look for patterns and buy points?
Yes, I consider the new factor. I don't, when I buy a stock, I'm pretty simple. I'm a simplistic person, a simplistic investor. Every stock I buy, I have only one objective. That's to hold it till it goes up to the profit goal. And I also use the 8-week, don't sell it to take profits before 8 weeks. That's a different rule than certainty exception. It's slightly different. And so when I'm looking to pick a stock to buy, that's my only objective. Now, when I'm making my watch list, and I keep a list of stocks that have something new, and if one of the stocks that I'm considering for my watch list has one of those new factors, it's more likely to get on my watch list than the one that has a nice setup that doesn't have the new factor, or maybe I just don't know what the new factor is. Most of the time, if I see a stock that's climbing like this, particularly if it's a huge stock like this one, institutional money is flowing into this thing.
Right.
There's something going on here. And, and maybe with the internet now, I just need to do enough digging to find out what it is. But I also keep a list of stocks that have a new factor, and some are on my watch list. And a lot of times the new factor is not as spectacular as it would be like with Amgen or, Microsoft or Apple. I totally missed the iPod. Apple's rallying away there in 2004 and 5, and I'm wondering what's going on with this company. And then somebody in IBD, an article mentioned the iPod. I didn't even know what that was. So I had to. Mike Scott and I went to an Apple store and learned what the iPod was, and then it was the iTunes also.
Yep.
It wasn't just the iPod; it was the iTunes that went with it. And then, of course, the phone. That was another complete game changer, wasn't it? I mean, I remember reading about them coming out with the iPhone and thinking, God, that everybody's got a phone. This is, you talk about putting your face into a competitive buzzsaw here. Geez, little did I know, but new is important.
Yeah.
Because it drives the sales and the revenue growth and the earnings growth.
Are there any other criteria that you really consider when seeing if a stock will come onto your watch list, whether it's, liquidity, obviously the earnings and sales, but are there any other kind of criteria that you use a lot in your screens or just that you take a look at before considering a stock?
Yeah, when I'm looking for watch list stocks, I'm looking for these 3 things. and with the computer screens that we have now at our disposal, the first thing I look for is the CANSLIM properties, high earnings growth, sales growth, the good CANSLIM characteristics. And so that's pretty easy to do. And even if you don't have Market Smith, we have the IBD 50 lists. And in fact, I start out with those lists.
Mm-hmm.
The 50 list is my go-to. If I'm busy, if I'm real busy that weekend, I don't have time to put into it, I want to at least look at the first 5 or 10, 15 items on the IBD 50 list to make sure I'm not overlooking something. One of the goals I have is never to look back and think, to see some stock like NVIDIA that took off and had big gains and I didn't see it and I didn't have it on my watch list and it was on the IBD 50 list. That's a real bummer. It means I wasn't doing my work. So I look at these lists and I look for stocks that have good fundamental properties, and I'll usually just start with the 50 and I'll go through and look at the bases. And when I'm looking at the bases, I'm just looking for the standard base formations that we all know about. And I'm also looking for the prior uptrend.
Right.
And that prior uptrend is an important thing for me. It tells me that the stock is under accumulation. And you asked about a liquidity requirement. 40 million shares, $40 million a day is my liquidity requirement. And most of the time I'm looking for stocks that are trading $100 million a day or more. Now I'll go lower at less than $40 million down to 10 million on IPO stocks. Or if it's something that I'm really, really interested in. But then I'll usually take less than a totally big position.
Right.
My portfolio, I don't let my CANSLIM portfolio get too big. I want to be a one-click investor. But if you got a couple $1 million and you limit yourself to 6 or 7 positions, I don't want to be buying something where I'm moving the market.
Right.
The market doesn't need to see my click. And so that's a liquidity requirement. And also another requirement that I have is if one of the top mutual funds doesn't have a stake in it, I look pretty scant at it unless it's an IPO.
Mm-hmm.
And so if those top mutual funds have a stake in it, it's probably trading more than $40 million a day worth. So that's what I do. I start with these lists and I just look down through them. And these are all right out of the investors.com. This is a list that I got that this man, Abe Christensen, got from portfolio managers at William O'Neill and Company. And it's looking for stocks that have projected higher earnings in the future. And then I'll look at last week's watch list. I keep a list in Market Smith of stuff that I like that doesn't make my watch list. I keep my watch list short, 9 stocks, no more than 9. I like to have it shorter than that. And then I'll pick out one that's my favorite. If I have too many stocks on there, then I don't make a decision, or they'll all break out at once and then it's a mess.
Right.
Then I have a list of stocks that are near my watch list. They're not quite there. Then I have the idea stocks, and these might be stocks that have something new, or they've had a huge advance recently, and I'm waiting for them to form a base. Like ELF was one of those recently. Abercrombie and Fitch, they just had a huge rally, and I didn't see that coming at all, but now I see it. And then, of course, the Growth 250 near a pivot point. And if I have a lot of time, I'll go through the Growth 250 list. It's pretty long, and it doesn't change that much, so I can go through it, once every few weeks and probably catch most of them.
Yeah, great.
But that's really my watch list process. Now, I also have been doing this a long time, and I have friends that do it. And some friends of mine and I, we have our own sophisticated, sophisticated is probably the wrong word. Complicated is a better word. Screen we do. And we come up with a list we call our focus list. And we take the whole IBD data, the whole market surge database, and we go through and sort through all those parameters. And we look some other things too, Weinstein stages and Janus relative strength stuff. And then we mash all that together and come up with a list of stocks to look at. And typically every week it's about 60 stocks, and they don't change that much every week. And then we go through and look at the charts on those, and some of those will make my watch list. I don't teach that at the meetups because it's too complicated. And it really isn't necessary either, actually. You know, if all I had was the IBD 50 list, I could make really good money at this business.
Great. And is there anything routine wise that you like to do that do every week? For instance, I was also curious. I want to ask you what your process was for analyzing the market to get that awareness to, are we entering a correction? Are we moving up the right-hand side of a base in the market? What do you like to do to keep tabs on where we're at with that?
The number one thing is to read the big picture and look at the market pulse and actually read the market pulse every day. And if I can't do it every day, I'll go back and read the ones I missed. That's my go-to thing. And so the commentary that they write in there, the stocks they note, the list, the data that's in the market pulse panel, that informs me a lot. And then I look, of course, at the chart. And so that's my go-to thing. That's my number one thing. So I'll do that. And I have a daily routine. I think daily routines are important. They're important for me anyway. And so I try to do that on my daily routine. And that's my number one thing on market. And so, I'll just be looking here like recently in the NASDAQ. And, you get up in this time frame here and the number of distribution days are racking up. And the markets had this terrific rally. It's been really a good rally. And, growth stocks have done well. My portfolio has done well and everything. You don't need to be a rocket scientist to know that the likelihood is at least flat, probably down more than up.
Right.
And so you don't need to, you just don't need to be too sophisticated. And what helps me is to write it down. So I make notes to myself that I keep, and then I can go back when I'm doing post analysis and see what I was thinking. Because if I don't write it down, I'll forget what I was thinking. When I come back to do post analysis here, I'll say, "Oh, I knew the market was topping." Well, maybe not. I need so that's the number one thing. Then I also I track the market school, and so that's you don't need to do that. I do it. I'm kind of obsessive about this stuff, so I track the market school. And not only do I track it, I have it programmed into an Excel spreadsheet, and I have it programmed into MATLAB. So I track it and then some. So I watch what it's doing, and all the buy and sell signals and stuff like that. And it's telling me the same thing that the big picture's telling me here, that there's a lot of distribution days and things aren't doing well. Probably more important than the market school is what my portfolio is doing.
Right.
So that's very important. And of course, I have my portfolio. I look at it every day, and I can see we get in this time frame here, the portfolio isn't going up that much. Maybe I'm not triggering sell rules and stuff, but the stocks I own, I own NVIDIA in here. Well, it's starting to look like the market, and then also, what are my watch list stocks doing? Are they breaking out and going, or are they breaking out and stalling, or are they breaking out and failing? So sort of all those things together informs me about the market. Now, so I pay a lot of attention to that. I spend a lot of time on that, and in fact, many other things. I track probably a dozen other things, and I do it with 3 other men. We keep a spreadsheet in a shared folder, and we look at junk bond ups and downs. We look at advanced declines. We're looking for, various signals like there's some strange names, one Hindenburg omens and stuff like this. We're looking at all that stuff. On the general market indicators chart page, they got the stocks with an A, B, C, and D accumulation distribution rating. We keep track of those numbers, and they inform us, but they don't. After all the time I've spent doing all that stuff, it doesn't really inform me that much better than reading the market pulse, keeping track of the distribution days, and watching what my portfolio and watch list stocks are doing. And I also look at the stocks on the move every day. And if I have the time, I chart through those, and I see stocks that are breaking out and I note them. I actually keep a list of them. And if they're breaking out and working, that's a positive sign for the market. If they're breaking out and not working, that's a negative sign. So in this time frame up here, you start to see stocks that are breaking out and they're not working.
Right. And would you be able to kind of talk through what your interpretation of the recent action is now? We had a definitive kind of bad break Friday, but now we've kind of had a 2-day bounce here. What are you kind of watching for and waiting for now with regards to the market, and also some individual names maybe that you're watching? Yeah. What are you kind of looking at now?
Well, these 2 days here are what I would typically call a dead cat bounce.
Right.
Up on declining volume. Now, I've learned through post analysis that for me, I just need to be in there optimistically thinking this might rally. And so I bought stocks yesterday and today. I had to sell a lot of I had to sell 4 stocks in the last week.
Mm-hmm.
And because they just triggered sell rules. Once I buy a stock, I don't sell it based on my assessment of the market. I don't sell it based on my assessment of the market. So I don't sit up here and say, well, I think the market's going to correct, so I'll reduce my exposure. Even though I study the market school and all that, I don't do that. That's not my style. So once I own a stock, it just needs to trigger a sell rule.
Right.
And then I'll sell it. And so what happened is when the market starts coming down like this, my stocks trigger sell rules. But as soon as I get an opportunity, if there's something set up, I'll buy to fill back up. And I may not go, totally 200% or 150 or 180% invested, but I'm on margin now. So I currently have enough stocks to be on margin. So, but I wasn't on Friday, the close Friday. I was on cash. So I bought 2 stocks. I bought Carpenter, CRS,
Mm-hmm.
right here
Mm-hmm.
Monday morning. It came down, and I thought, well, I'll just buy it. I should have bought it over here, but I didn't even see it over here. And then it broke out here, and I saw it because it was on the market pulse. And this is a really strong relative strength when everything else isn't doing so well.
Yep.
And so, and then the other one was Texas Roadhouse.
Mm-hmm.
I like to set up, I bought it a little bit early here. It did, I bought it before the breakout. I do that sometimes, but look at this. This is the thing that attracted me to it. Plus it has decent fundamental characteristics. And so now this earnings line isn't, I prefer to see this. I'm glad they put this on the charts. I used to do this by hand, because you have all the data here. And I like to see it a little bit stronger than this. But this is a good chart pattern here and a good strong prior uptrend. And this outfit can expand pretty fast. And so anyway, that's the way I read the market. And right now the market is in a correction, and it's likely to correct more,
Mm-hmm.
in my view. This is a very weak bounce here. There's been a big run up. You know, this rally, I believe, started here because the marketplace thought the Fed had accomplished the soft landing, the elusive soft landing. And so they accomplished the soft landing. They're going to be able to ease interest rates. But then in recent weeks, the data is coming in indicating maybe not. And maybe inflation is more persistent than the marketplace thought. And so I think the most likely direction is down, but I'm not a short seller. And so I do what I do.
Mm-hmm.
And my reason for thinking that is A, look at how much rally we've had. B, there's a whale of a lot of distribution in the market. The market pulse stops counting it, but I keep counting it. The market school keeps counting it. And there's been some significant selling here, and this is pretty weak.
Mm-hmm.
Now, this day here could technically have qualified as a follow-through day, but it's pretty weak follow-through day. Volume is below average, and you know, it's more than the day before, but you know, not very strong. And of course, it's only the second day of the rally, so.
Yeah, and one thing I wanted to ask you, we've talked a little bit about your weekly routine, both building the watch list and analyzing the market. Would you mind going through maybe your daily routine as well, and
Sure.
maybe kind of preparation of making trades, maybe not in a corrective market like this, unless it's kind of the same thing. But yeah, just kind of walking through your daily routine, how you prep for the day, and also if you do anything after the market closes as well.
This is my daily routine.
Mm-hmm.
You know, the first thing I save data. So every day I download the MarketSmith data for everything. And I put it's an Excel file and it goes in my computer. And, you know, computer, I mean, I need to get a new hard drive. I've got 2 terabyte hard drives sitting in a box here because I filled up the 1 terabyte. But, you know, they're cheap. And so you buy them, you put them in, and you save stuff.
Mm-hmm.
And then stocks on the move. I look at that and I download and save it. And it just takes a few minutes and it's routine. Then I look at the Growth 250 breakouts today. They have a list of breakouts today that are on the Growth 250 using pattern recognition. So I look at that to see if there's anything breaking out that I haven't, you know, that I wasn't aware of, that maybe I should be aware of. And the same thing, that's why I'm looking at the stocks on the move. Is there some that's moving on volume? Now, I'm told, you know, Mike Webster recently did a webinar where he talks about volume is not, it's corrupted by just the way the market is, but it's still important to me. You know, if I see something moving on volume, it gets my attention. So then I look, I use the TQQQ stochastics. I look at that. So I look at that every week. I look at the market school model. And then I look at the distribution count and I keep close tabs on that. Then I look at my portfolio. And this maybe should be I look at this during the day sometimes, but I look at my portfolio and I want to make sure that I look carefully. And what I'm looking for is to see if any sell rules need to be exercised.
Mm-hmm.
I don't want to overlook a sell rule. Lee has a good day in the market, good day at work, if he follows his rules. It doesn't matter if I make money or lose money. If I follow my rules, I had a good day. So I could go to my boss and say, I followed my rules. And he'd say, cheery aye. And so I look at my portfolio, I look at my watch list, then I like to read the big picture. And I read that and I pay attention to the stocks they were mentioning in there and the market pulse. And then I keep a list of stocks that are breaking out that I see from it's not every stock that's breaking out. It's only stocks that would make my watch list.
Mm-hmm.
They don't need to be on my watch list. Maybe I didn't have them on my watch list, but if they have the type of characteristics where they could be on my watch list, they go on my breakout list. I don't put stuff on the breakout list that just suddenly took off and, and it's not something I could buy.
Right.
It didn't have a base or it doesn't have good fundamental properties.
And is this what you do kind of after the market closes every day?
Yes.
Yeah.
After the market closes, sometime before the next day, I try to do all this. Now, sometimes I can do this during the day.
Mm-hmm.
I can keep track of my portfolio on my watch list during the day. And I can look at the market school model and I'll know whether it's going to trigger a buy or sell rule. And I can do the stocks on the move during the day. And then I'm ready for, it's a non-event, by midday, this doesn't change that much most of the time.
Yep.
And the same thing with the breakouts on the growth 250. By midday, they probably broke out or they're not going to. And this stochastics thing, it's a weekly, so, it doesn't change very much.
Is there anything you like to do in the morning before the market opens to kind of prepare yourself?
Well, the day before or the morning, I like to make sure I know where any of my standing orders are.
Mm-hmm.
And so I keep a list of those, and then I can go also to the broker and just check. Because I put, one of the ways I work is if I see a stock that's set up, I'll put in an order if I have the buying power and I'm comfortable, buying it. So, if I want to buy this stock right, say, this 1400 or something, I'll put an order in to buy it.
Mm-hmm.
And it'll be a buy stop always with a limit. I don't want it to gap up here and then I get filled way up here. And so I just need to keep track of, make sure I don't forget something. And then, or that I don't have too many of them in there and then I run out of money. And the same with selling. If I don't use sell stops, protective sell stops very much. I will, if I'm not going to be able to watch and a stock is getting near a buy trigger, I'll put a protective sell stop in. If I have one of those, like NVIDIA, it triggered one of those sell rules here. This day right here, it closed below the 21 day. The sell trigger is the low of that day. So I'll put a sell stop in, the low of this day was like 467. I'll put a sell stop in at 467.10 or something.
Mm-hmm.
And so I want to make sure I know where my orders are. And so I check that. I usually check that every day.
Mm-hmm. And
I don't
go ahead.
trade that. I don't make that many orders, actually.
Mm-hmm.
I mean, this is NVIDIA recently. And, it looks like a lot of orders, but it's less than one a week. And my portfolio typically only has 6 or 7 stocks in it. And this is a lot more action than most of the stocks that I own. I suspect my average is just a few trades a week.
Mm-hmm.
Now, sometimes, like last week, you end up having to sell quite a few things, or sometimes at the beginning of a rally, you'll be buying a lot of things setting up. I used to buy, I used to scale in B1, B2, B3 for the initial position. And then a few years ago, I did post analysis and I found out that I didn't need to do that. So I simplified and I just buy one position, the initial position. So that simplifies that.
Mm-hmm.
I used to buy B1 to be half my desired position, right at the pivot point or it's not the pivot point, it's what I decide is my desired buy point. And this one here was probably a trend line or something that I drew here. And so then I used to do B2 would be like 2.5% above that, and B3 would be like 4.5% above that. I picked that up from one of the workshops that IBD had, and I used it for a long time. but I went back and studied my work, and I found out it was I didn't need to do that. I do better just making one buy.
Mm-hmm. And once you have a position, Lee, do you have kind of a favorite risk or position management rule that you think, you know, might help traders out there who are watching this?
Yeah, I don't have a magic wrench for that. I have a set of sell rules that as soon as I own a stock, some of my sell rules are going to immediately apply.
Mm-hmm.
And so if I change date back to this guy here when I bought him. So I bought him here, and I think my trigger here was he's coming off the 10-week line, and it's a good rally, and I just wanted to get in early.
Mm-hmm.
And or the 50-day line. And so I just bought him. I bought him near the close this day. Well, immediately it's a capital protection sell rule. If it goes down 7%, on a closing price basis, I'm going to sell it, no questions asked. And or if it goes down 9% intraday. Now, I don't put a broker stop in for that because I'm watching this thing obsessively, you know. And if you're not obsessed like I am, you probably should put some stops in with the broker. You don't want to look up and find out it's way down here somewhere. And then that's the first sell rule. So and the next sell rule that immediately applies is I'm going to sell this when it's up 25% from the standard pivot point,
Mm-hmm.
which would be this right here, or I could use this, but I'd use this right here. So I would calculate that, and I would know where it was, although it wouldn't be applicable yet. Now, another sell rule that is useful is if this breakout fails. Now, this is a more subjective rule. I mean, the minus 7% is very objective. It either does or it doesn't trigger that. And the minus 9% intraday is very objective. And the profit goal is very objective. It's a certain number. You calculate it. And you can put an order in for it, you know, if you want to. You know, I mean, it's pretty far away from that, if the breakout fails, that's more subjective if it doesn't fail to the minus 7%. But that's a sell rule I use, and it's very handy when the market's crummy, like it was for the last, you know, like
2022.
the end of 2001, we get this correction, and it was a crummy time for me, even in 2022, and I had a lot of those kind of failures. So, and that's a more subjective, and it's skill. You just chart reading skill. You know, you see that, well, okay, this ain't making it.
Mm-hmm.
And this one here, actually, if I recall, oh, it went right away. If I had purchased this guy over here, if I had bought him at the standard pivot point here, I would have sold him over here somewhere and said the breakout failed.
Right.
And that's perfectly okay. And it doesn't mean that he's not going to be good later. Now, if I'd bought him at the shakeout +3 here, which I didn't because I didn't have buying power, I wouldn't have worried him here because he would have been profitable, and I just would have sat until he finally got going. And, you know, this kind of thing demonstrates, geez, you know, you just never know, huh? I mean, why did he get going here and not over here? You know, I don't know. Somebody probably knows, but I don't. I mean, the market was rallying over here. The relative strength line was coming off pretty uncomfortably here. And then all of a sudden he's taking off here.
Yep. And
so that's those are the, and then another sell rule I have that I use a lot is after the stock's up a certain amount, in my case, it's 11%. When it's up 11% from the place where I bought it, then I have a rule I call decline from the peak. And if it comes down 14.5% from a recent high, it's probably broken, and I sell it. That's my decline from the peak. It's out of Bill O'Neill's book, but Bill O'Neill doesn't tell you how to implement it exactly.
And do you have a sense of your batting average over time and also kind of your average gain and average loss?
Yeah, my batting average is pretty awful. You know, I buy a lot of stocks that don't work,
Mm-hmm.
and so and I don't worry it. I used to worry that. One of the aspects of this business that's difficult is you make a lot of mistakes. In ordinary life, we don't do that. Fortunately, you know, the airline pilot doesn't hit the runway hard very often. You know, in this business, you hit the runway hard pretty often. In fact, sometimes you push the landing gear right up into the cabin. So, you know, you just got it. This is more like sports.
Yep.
You know, you're out there on the golf course and you don't hit the perfect drive very often. You do it poorly more often than not. That's my experience in CANSLIM. And so I did compile statistics recently, and I'm not sure if I have those here handy, but in the period of time from January 2021 through September, or up to the beginning of September 2023, my batting average was one good one out of five and four failures. So I was batting 200.
Yep.
And now the way I define a failure is if it doesn't make the profit goal or better. So on this stock here, you know, my profit goal is here. I'll put a line on the chart. And my time goal is here. If it doesn't get to the profit goal and I sell it, you know, because it failed or triggered a sell rule,
Mm-hmm.
it's a failure. Now, it doesn't mean it lost money. But, you know, so in that time frame I just described, it wasn't a market that favored me. It didn't favor my methods of picking stocks and managing stocks. You know, first of all, from December of 2021, you know, or the first of 2022, yeah, the end of 2021, the whole year of 2022 was pretty much a bear market. And I do long in here. I'm not doing shorts. And so, you know, I didn't do, you know, I had a lot of failures in here. Now, I would buy stocks when I thought they were the rally day. So I probably bought stocks here, I bought stocks here. And some of these worked. They didn't all lose money. And I would have bought stocks here and they probably lost money. And then I bought here and I probably had some good profits in here. And then again here. And then finally the market gets going. This time frame in here was awful for Lee. It looks good on the chart here, but not for Lee. And I'll tell you why. If we look at the IBD 50, that time frame, that's the IBD 50.
Mm-hmm.
So we have this huge correction here. We finally get a new market rally here, and it lasts a month. And then growth stocks, the kind of growth stocks that Lee picks, does this, you know, for the first, you know, 3/4 of the year. And if you get into the details of this, it's 1 week up, 1 week down, 1 week up, 1 week down. What does that do to a person that invests the way I do? Well, it's pretty awful. And so I had in this time frame from here to September, in that time frame, my batting average was 200. Now I made money. I made good money. Part of it was luck, and part of it is discipline, because I didn't let any losses get very big.
Mm-hmm.
I took some losses that were 7%, even 9%, you know, and if I have a 9% intraday trigger, it's going to be 9.5 or 10% by the time I get filled. I took some of those, but not very many. Most of the failures were the breakout, you know, was failed breakout sell rule. I have a rule that the breakout didn't even happen. You know, I bought it early and it never happened. So that happened a lot in here. But I made money.
Mm-hmm.
And one of the reasons I made money is I'm pretty rigorous about selling at the 25% profit goal. I didn't change that and use 20% in here. I stick with 25%. And then I was lucky and I had a couple of really good stocks in this time frame that I kept past the 25% profit goal and that made good money. One of them was NVIDIA.
Mm-hmm.
Was in here. I happened to get it at the, luckily, and there were some others. So, and then my practice is I'm pretty fully invested all this time too. I'm, using margin. And so, but the batting average looks pretty dismal, and you just have to not let it bother you that you're having a lot of stocks that aren't working. You just keep at the job.
Yep. And you've mentioned, post analysis quite a bit today, and kind of pointed to it as how you've looked to improve and refine your rules and that sort of thing. Would you mind kind of talking through kind of your process for that? How you go back and study previous winners, previous trades, previous markets as well, to try to refine that system.
Yeah. Let's look at we'll look at a recent one. We'll look at NVIDIA again.
Mm-hmm.
And so, I try to keep good data so that I have the data to do the post analysis. So I will have, I save my watch lists. I have notes that are in the watch list process. I save that. And I save copies of the EIBDs and the database and all that. So I have the data I need to go back and look at these things. And so this one here, if I'm doing post analysis, I'll look again and, well, why did I buy it right here? Was this really a smart move? I mean, it turned out okay, but was it really, if I had it to go back and do it again, why didn't I buy it here?
Right.
And so I'll go back and look, and I've already done that. And I know that reason I didn't buy it here was I didn't have buying power. And then it pretty much got above that buy point, so I just let it go. I didn't have, I just didn't have buying power, so I couldn't buy it. And I didn't think of selling something. Maybe I should have sold something. This is really a good stock. But I didn't really realize it was that good at this time, actually, because the earnings line was turning around and sales and stuff. So this rally would surprise me. I didn't think it would be this good. So I'll go back and then I'll look to make sure that I didn't miss an add-on buy point, or that maybe I stuck one in that wasn't really appropriate, and that kind of thing. This isn't a hard one to do post analysis on because it was so successful. But let's look at here's another one. I bought this one recently. And, this is going to be a harder, I still own it. It's going to be a harder post analysis.
Mm-hmm.
Maybe I should have already triggered the sell rule that says this breakout failed. See, that's where it becomes subjective. I bought it here on this day right here.
Mm-hmm.
And then the breakout didn't occur. See, I brought it earlier. The next day it's down like that. And it opened with a step down. Not a gap per se, but a step down. So like this day, so that's a breakout failed. That's a breakout didn't occur sell rule. Okay, so I had this guy on my watch list. I sort of like the fundamental characteristics here. I made little notes to myself here, stick them right on the chart. Then I'll make screenshots of the chart, stick them in I use a PowerPoint. So I go back and I have these notes. So I bought this guy right here on this day using this little early buy point. And then the next day he opens down and I'm out of here. Well, then he rallies. And so I bought him back and then he has this day and I'm thinking, aha, this is great. Well, then it turns out this is some news and it may not be all that great. Acquisition tease.
Yeah.
And since then, it just ain't making it. And of course, the market's not making it. And so I'll have more chin stroking to do when it comes to post analysis on this guy, including, was it a good pick in the first place? So I do that. Another key post analysis thing I do is every once in a while, and I don't do this every year even, I'll do that portfolio model post-analysis where I'll do a model portfolio. I saw Bill O'Neill do that in a master's class, and boy, it was an eye-opener.
Mm-hmm.
And so I do that, and that helps me learn portfolio management and the relationship between the stocks I might own and the sell rules and the market and all that stuff. So I keep good data, and then I go back and I look, and I keep notes too.
Mm-hmm.
So when I keep these trades in an Excel spreadsheet, and I'll keep notes in there about why what sell rule I used I'll even make notes about what kind of order I used. Did I use a buy stop with a limit, or did I buy it pre-market or post-market? Because I'll forget if I don't write it down. And then I go back and I have the information and I can just learn from it. So one of the things I said earlier was I went back and studied a few years of the stocks that I bought. Some were successful, some weren't. I mean, most of the time my batting average isn't 200. It's closer to 350 or 400. But I'll go back and I'll look at all those and I'll think, well, did I benefit by the scaling in thing
Mm-hmm.
or not? And I found out, no, I didn't. Because the stocks that I kept till they got to the profit goal, I made less money on the initial position, and I would have made better money if I'd bought just one position.
Right.
And I didn't save that much by the scale in thing.
Mm-hmm. And Lee, were there any other charts or names you wanted to go through, or anything kind of other things related to charting that you wanted to talk through today? I don't think I have any other specific questions related to that, but just wanted to see if there's anything else you wanted to mention.
Yeah, one of the stocks that I learned a lot in the way of CANSLIM investing, more with it. I owned NVIDIA at another time,
Mm-hmm.
and unfortunately, I didn't keep it until now. I have a friend whose son works for NVIDIA and has been working for him for a long time, and he has a huge amount of NVIDIA stock. But I bought this in March 2016, and I held it for I don't think I had long-term capital gains on this. 42 weeks. I don't have long-term capital gains very often.
Mm-hmm.
In this business. That's something I'm trying to work on. And so this was an easy pick. It was on the IBD 50 list. It had a double bottom base here, a shakeout plus 3 setup. I didn't buy that. I bought the handle breakout here, and I didn't really call it a double bottom. I called it a cup with handle.
Mm-hmm.
And and this sloping trend line on the handle high is one of the early buy points Bill O'Neill talked about in The Successful Investor. I use that. I like early buy points. And this guy was just beautiful.
Mm-hmm.
And but he got up here and he triggered about climax tops are kind of iffy, but he triggered about 7 climax top
Rules, yeah.
ideas, and so I sold him up here. Now, as it turns out, you could have held him, and he went on and did great things. But that was a good trade, and I made add-ons along the way here, and sold it at the climax top. And I like these lessons that O'Neill had in his book.
Mm-hmm.
Too. I recommend people study these. This is the Simpson Precision model stock. And right here is where he talks about the big cushion sell rule. you have a big gain and a cushion. So you must hold longer until a very clear sell signal of closing a week below the 10-week moving average line with volume for the week over 40% or textbook climax top occurs. Now, in the Model Stock Summit, Bill O'Neill spent some time, as I mentioned, talking about figuring out a way to hold on to more stocks for a bigger gain rather than selling them all at up 20 or 25%. But part of that was also this sell rule here.
Mm-hmm.
And he talked about this quite a lot, and he showed examples. And he said it really should be higher volume, probably 40%, and not just a smidgen below the 10-week line, but more like, 2 or 3% below the 10-week line. Unless it does that, you want to try to hold it through. He said, and if you're going to hold a stock that's going to go up 4 or 5, 600%, you've got to be able to hold him through a base. And of course, in the front of his book, that's what he shows. He shows the stock sliding day. So you need to figure out a set of rules that work for you that'll let you hold it through a base. But on the other hand, if it's really failing, you don't want to stay glued to it. You're not marrying it. And then he has this in this particular example, he has this little statement here that I just love. In the next 20 years, there'll be 200 stocks that will go up 5 times or more. Getting just 2 or 3 could just change your whole life. That's really quite so. You don't need to be doing this investing stuff full time. You pick 1 or 2 stocks in 20 years that go up 5 times and you manage them properly, it changes your whole life. You got it in a retirement account or something. Now you got a serious retirement account. And then he goes on to talk about encouraging stuff here. And he says, develop a few motivated friends who are also seriously studying CANSLIM and work with them. And that's an important thing to do to stay in this business a long time. You got to have some friends you can kibitz with and share information with. Otherwise, you get so isolated, it's no fun. And that's one of the good aspects about meetups. But a lot of people don't live near a meetup. But now there's meetups that are Zoom, and you just work at it and try to get some friends that you can kibitz with. I have a half a dozen friends now that I regularly kibitz with, and it makes this a lot more fun, more interesting. Every week I have 2 Zoom sessions with people that are, that I share. We share a common enough methodology that we can kibitz.
Mm-hmm. Yeah, great. And did you want to mention your meetup and where people can learn more from you if they'd like to?
I'm not doing that meetup anymore.
Okay.
The meetup is still there. It's the Petaluma IBD Meetup. People can join it. And I have a lot of information that's posted there that if somebody joins this meetup here, Petaluma IBD Meetup, I have a website that hosts all the meetup presentations I did in the past, but I'm not currently doing any more. And I stopped doing them during the COVID. And there's a lot of good virtual meetups going on. And quite frankly, I didn't have much to add to what I'd already done, So I haven't done live meetups and I haven't done virtual meetups. Now I do presentations for other meetups. And once a year, we hold a joint Bay Area IBD meetup, which you can find on the San Francisco IBD Meetup website. And this year, it's going to be the end of September this year. And it will also be, virtual. So the San Francisco IBD Meetup website has that one. And so it'll be, I suspect the slots to come to it live are probably already filled because we're not renting a huge conference room, and then you can sign up for it virtually and get it. It's a 2-day meetup, and actually virtual is a good way to do it because you you get the recordings and stuff. You'll get the recordings if you go to it live as well. So
Great. I'm going to stop your share, Lee, because I just have a few kind of last closing questions. This has been really fantastic, by the way. First things first, do you have any advice for traders in terms of, managing their life, managing stress, while doing this long term? Because obviously it can take a toll, especially, during longer term corrections, all of that. So any advice for people to help kind of structure their life so, they can do this in a very sustainable and successful way?
yeah, I can think of a few things. One is don't depend on your investing money or your trading money to live on. Don't quit the day job, because the worst thing that can happen is you're under pressure. So don't try to transition to full-time investing before you're ready. And I've told a lot of people in my meetup, don't do that. I mean, people get enthusiastic about this. They want to spend all day doing it. They don't like to have to go to a real job. And a lot of people have good money set aside in a retirement account, but boy, if you give up the day job and you're depending on earnings from your investing, it can screw you up psychologically.
Right.
So don't do that. Don't put yourself under unnecessary pressure. Then I have if you're not sleeping well rule, sell off until you are. Just empty the portfolio and sell the underperformers first. Keep the better ones. A lot of times it's tempting to sell the ones that have profits, but sell the ones that aren't working until you can sleep comfortably. If you're worried about it, to get unworried. And then the other thing is, if you're stressed out about it, just give it a break. Go flat, sell everything, and just let the cash sit there and wait till you feel like coming back to it. It's not for everybody, and there's a lot of other ways to invest your money. You don't need to do this, and maybe it just isn't for you. So if you feel stressed out, just give it a break. I've done that. I remember the last time I really did that was quite a while back, but I just took 3 months off, and I just went flat and decided to do household projects and other things. And unfortunately, I stopped saving my EIBDs. I wasn't diligent about saving those. And so when I went back to get them, I called up IBD and I said, geez, do you guys can I get the PDF files? Oh yeah, Mr. Tanner, no problem. Which ones do you need? And so I give him the list of about 300 of them or 200, or I'll give him a list. It was daily in those days.
Yeah.
And he said, now that'll be $5 each. I said, are you kidding me? Oh, well, for you, it'll be $1 each. So anyway, I'm more careful about saving them now. And of course, if I don't save them, I know people who do. So, but yeah, take it easy. Just take a vacation and don't quit the day job before you're really ready to do that. And I also tell people, don't have unreasonable expectations. You can make a whale of a lot of money doing this, and you have to have reasonable expectations. Nothing that enables you to make this kind of money is going to come quick and easy. I mean, Bill O'Neill says in his book, it's easy and all that. Well, that's a bit of an exaggeration. Imagine you wanted to become a CPA and prepare and do tax preparation for a living and make good money doing that. Well, what would that take you? 6 years, 7 years? I mean, longer maybe. You got to get enough education to be able to qualify for the CPA exam. You got to get work experience before you can take the CPA exam. You got to build a practice. I mean, so 3 to 5 years of studying and really working this is not an unreasonable thing before you really start getting good at it. So don't expect good things to happen in 3 or 4 months or 6 months or even a year and a half. And then, so don't put unreasonable pressure on yourself by having unreasonable expectations.
Mm-hmm. And then
the other aspect of it too is recognize that this is like sports, not like real work. you're going to make just a lot of mistakes, and, you know, you're going to swing at the ball and miss. You're going to have foul balls. You're going to have strikeouts. You're going to have, you know, use whatever sports analogy works for you. You're going to slice it. You're going to do all, you know, that just happens. And for Lee, there was an epiphany I heard in one of the workshops. You asked about that. It was the 2002 workshop with Bill O'Neill, and he had security people there. He had these big bruisers that had bulges in their coats, working the room, and metal detectors to get in, because he'd apparently had threats. And so, you know, and the market was really awful at that time. Right then, when we were having the workshop, the market was really awful. It was correcting horribly. And somebody in the class raised their hand and said, "When do you get scared?" And Bill O'Neill said, "Oh, I never get scared." And the person said, "Well, how can that be, you know?" And he said, "I have a rule for every occurrence, and I always follow my rules. And so there's nothing for me to be afraid of." And boy, I'll tell you, I wrote that down. Oh, I scribbled that as quick as I could, because I was sitting in that room afraid. And so I'm afraid of the market. I don't know what the hell is going on. And I'd had such an easy time during the 90s, and now the wheels are coming off. So I wrote that down, and I thought, I need to get a rule for every eventuality and be sure that I follow my rules. And for me, that was a fairly easy task, because I came from a rule following background. You know, I was an engineer, I was technical, you know, I was engineering, and, you know, I was a Navy officer, nuclear power, you know, we followed the rules. There was a rule for everything, and we followed the rules. I can remember one time the head of the whole Navy nuclear power program said that if you need to do something to my reactor plant and there's no procedure or rules to do it, he said, you write one before you do it. So it's kind of like CANSLIM, you know, you got to have a rule for everything and follow the rules. And if you do that, and it might take you a few years to get there, you can be comfortable and you won't be so nervous, because you'll have a rule that'll take care of you. It's a rule that'll allow you to keep the stock till it gets to the profit goal, but will get you out if it's not working.
And I think one of my favorite moments from today, and a takeaway for me, is you saying, it doesn't matter if I made money or lost money today. If I followed my rules, it was a good day. I really like that sentiment. I think that really resonates.
That is so true. That is so true. And, you know, and that was easy for Lee, because I came from a background where that was true. You know, when we were operating in a nuclear submarine, if something went wrong, the first thing you wanted to be able to say was, I was following the rules. I was doing it per procedure. And if you could say that, you were okay. Now, if you were screwing around and doing something that wasn't per procedure, you might be in serious trouble. So I applied that. I heard Bill O'Neill make that statement in that workshop, and I thought, boy, that's right on. That's for me. And it really makes life easier if I can do that.
For sure.
And the challenge, of course, is to develop a set of rules that you like and you can use, but you do that over time. And O'Neill gives us good rules in his books.
Yeah, and suits your individual personality, right? Because we talked about Charles Harris, who likes to buy the pullbacks more, Mike Webster, who's more the breakouts. It's got that rule set has to kind of fit with you and how you view things, right?
That's exactly right. That's where post-analysis comes in. You know, in post-analysis, I figured out that I don't like chasing stocks. You know, it just doesn't work for me. So I tend to look for early, like this guy here. You know, I don't want to buy it here. I'd rather buy it here. And knowing that this isn't the breakout and it may not work, but I'd prefer that. Or the shakeout plus 3 thing, or this guy here is a double bottom. Here's the standard pivot point, but I look for a handle here. And so that suits my personality better. And each person will figure that out for themselves by just going back and reviewing what they did.
And do you have any kind of last piece of advice for anybody watching this to, help them find the way, help them develop their rule set, or, just kind of general rules of encouragement to help them kind of achieve success over time, studying CANSLIM or, an adjacent trading system?
Yeah, common sense. One of the most difficult aspects of today's environment for people starting out to invest is we have information overload. When I started learning this in the mid 80s, there was nothing. The chart books and the models in the front of the chart book. Now we have so much information on the internet and everywhere. There's lots and lots of books and methods and different ways and advisors and stuff. And so information overload is a problem. And so I encourage people who come to meetups to decide if you want to do CANSLIM, focus in on that for at least a year and push aside all the other things. And of course, now we have the additional challenge that IBD has various types of CANSLIM. We have the I forget what they're all called now, but there's a swing trading. There's a leaderboard, and I think there's others, and they have the morning discussion. And so there's a lot of effort, a lot of emphasis in the shorter term trading. So I encourage people, if you want to do CANSLIM, to focus on Bill O'Neill's books and study those and really spend some time with those. And then also the investors.com has good educational material, but focus in on trying to do CANSLIM the way Bill O'Neill described it. And then if you at least learn that, and then if you want to, after you learn that, you can evolve and make changes. So Lee tends to be, I don't tend to hold stocks as long as Bill O'Neill does. And I tend to make more add-ons than Bill O'Neill does, but I tend to stick to the basic O'Neill system pretty closely because it works for me, and I've learned that over the years. So I'd like to learn to hold stocks a little bit longer, but I also know I don't like holding stocks through bases. And I also don't have as much money to invest as Bill O'Neill. Lee never has to scale out. That just doesn't happen. It's a one-click, I'm out. And I don't build a big CANSLIM trading portfolio. When I have extra money, I put it someplace else. Because it gets too big, and I don't want to move the market, and I don't want to have that complication.
Great.
Did I answer your question?
I think so. And once again, Lee, I just really want to thank you for your time. I really enjoyed this, and I think everybody watching will find it really valuable to hear your story, your process. Is there anywhere, if people want to get in touch, they can reach out to you if you'd like that? Is there anywhere specific to reach you?
Yeah, my email address. You want me to write it up here?
Yeah, or you can send it to me later, and we'll put it in the chat.
You have it.
Okay. Yeah, I do. I'll put it in the chat.
Put it in there. They can email me. Yeah, sure.
Cool.
Also, they can join the Petaluma IBD Meetup. There's a lot of, there's probably a couple of hundred. There's probably 100 or more presentations on there about how I approach this that are all still pretty relevant. And so, and if people have questions about any of those, they can email me.
Yep, great. Well, Lee, thanks again for your time. To everybody watching, I hope you guys enjoyed this. If you did, please go ahead and leave a like down below. Subscribe if you're new to the channel, and we'll see you guys in future videos. Take care.